the vibe that you're distant. There's something about you that's different. I see it in your eyes. Something isn't right. Tell me again what I'm missing. 'Cause you're fading out. We've been here before. Tell me again, just tell me again, and I'll make it right. Don't go through that door. Tell me again, just tell me again, and I'll make it right. It is a lie when you tell me that nothing is wrong, just leave it be. But I see it in your eyes. Something isn't right. Tell me again what I'm missing. 'Cause you're fading out. We've been here before. Tell me again, just tell me again, and I'll make it right. Don't go through that door. Tell me again, just tell me again, and I'll
Happy Tuesday, everybody. Happy Tuesday, Rodney.
How's it going, Andy?
You know, it's going, it's a day. It is a day.
A
So,
day, a day in the life of a real estate agent.
yeah, a day in the life, man. I'm telling you. Just do a little
Let me get
technical here.
squared up
Hang
over here.
on.
My set director took
There
the
we
day
go.
off.
Okay, good. All right, and everything's running on this end. Look at that. For once, everything seems to be up and running. I can see you good. Make sure I've got return to green. Good, good. So, did you do any hunting over the weekend?
Well, I did. I've only when it's duck season, I only get 60 days, so I try to get in as many as I can. And with our industry a little bit slower this time of season and this year, I've taken advantage of
Oh,
that.
good for you.
Yeah.
Anything else exciting happen? Nothing.
This weekend, my Niners beat the Cowboys just like always.
That Brock Purdy is looking purdy.
Isn't that something that this kid come out, off the bench, being obviously the last draft pick in the draft? It's pretty crazy.
Yeah, and now he's won 7 in a row.
Yeah,
7 in a row.
yeah,
I mean
he's
that.
well, it, and they don't give him credit for the game he come in. I think he came in on the Miami game in the first quarter, and they were losing. And he come back and won that game. They should really give him credit for that.
It just the composure for somebody like that. Some of these when people are 23, 24, 25 years old, they got their stuff together.
Yeah.
Good. Okay. Well, good. I actually didn't know you were a 49ers fan. Didn't know there was a connection there. So now I can root with you. All right. So here we go. We're going to start with Rodney's rate.
Let's do it.
Oh, yeah. That's right. That's right. What do we got? We got any screens
All
to
right.
share?
Yes, sir. Let's go.
It has been a crazy week, if I'm not mistaken. Ready?
I am. This is just a good look at today's rate. Something a little bit different. It's called our Japanese candlestick chart. You can see kind of the highs and lows of the times. This means it may have went down to there and then come back up. But the red means it's going in a bad way, and green means it's going in a good way. So right now, our mortgage-backed securities are up 16 basis points. When they get 20, 25, they start getting close to what's called a lender reprice,
Uh-huh.
and gets a little bit better. Lenders will cease pricing today and issue a new price that's just a hair better, and start again over and over like that. So that's a look at today's. They're still holding very steady compared to where they have been. Actually, kind of getting up. What am I trying to say here? Holding steady. You see, I keep going back to this date a long time ago, and it's
Yeah. Yeah.
you can see where this happened right here now on what was this date? The 23rd. We broke through that floor of support, but it looked like we regained it and got it back above it. So that's good news there. We want to be above any floors of support.
Any
So
floors of support. And that stabilizes pricing. Is that what you're saying?
it's by what the way they explained to me the candlestick, the Japanese candlesticks here is that those are kind of a moving average, and they call it a floor support because it seems like if you look at the line on there, you can see how rates at times bounce off of it,
Yeah.
and it's like they're going bad, but they bounce off that what's called that floor support and stay above it. What gets bad is when they go below it, like over here, you see they go below, go below, go below,
Right.
and then when the support gets up, the however you want to call it, the floor support is generally hard to break through as long as the ceilings with the ceilings as well. The same goes with that ceiling up there. It's hard
Got
to
it.
break through that ceiling.
And so if you're staying in between, then you're in reasonably decent condition.
Yeah, as long as we keep inching that floor support up like we have been, that's what we're looking for.
Got it. Got it. Okay. Good. So, and do you have any particular expectations, or just it is what it is for today?
It is what it is for today. It's whenever I give advice on like I'll look at this right here, a morning update. Like this position says, it come out this morning, tells us to carefully float, tells us what the economic indicators are, because it can't. I can't really give long-term advice on what do you call, I guess, rates, if that makes sense. It's
Makes
hard to
total.
give long-term advice on rates.
Yeah.
Meaning, I don't know what they're going to do in 6 months, and neither does anybody else. But we can look at the market conditions right now and give you advice when you are, when you're deciding on purchasing or things like that. So,
Got it. Yeah. And that makes total sense. I imagine you have people every day that, that it's asking you for advice on when to buy and what a rate's going to do and all that kind of stuff. I would think that's a daily occurrence, right?
right. Anytime we're talking about loans, a customer's like, well, what do you think about the rates? What do you think they're going to do? And sometimes, um, we we'll get somebody that's I'll get somebody that's a market expert, right? And I'm like, well, man, you seem to know more than I do. Like, what are you thinking? But
Yeah.
I'm not a market expert, but what I have done is I've these guys from Mortgage Market Guide, or let me make sure I get their name right. They are MBS Highway is who I use, and they're to me the best people I've ever seen. Keeps me from having to be a market expert, right? I mean, they give me the information that I can pass along, and I can't study that stuff, like a stock all day long and see what it's doing, what it's
Right.
moving.
Right.
But these guys do, and then they provide it. They provide in bite size information for us. That's really really good.
Yeah. And you know what? I do the same thing as a realtor, because people will ask me essentially the same questions. And I decided 15 years ago that I'm not a lender. I don't play one on TV. I don't want to even rub up against that. I don't want that. And so I send them to you on what their particular situation is, not the market in general, but what their deal is, because it's different for everybody,
Exactly.
But the one thing, what you're teaching us, and this has been going on for several weeks in a row, which is the good news, is from that where it did break through the floor a while back. It's historically, recently, it's looking pretty stable. So moving
It
forward,
is, isn't it?
you can kind of expect that to continue. Who knows?
Yeah.
Tomorrow. I mean, your car could blow up tomorrow. Who knows?
Who knows, right?
Things change unexpectedly.
Yeah.
Anyway, so that's a good
Anybody
update.
anybody with a good vehicle for sale, hit Andy in the inbox.
Yeah. Anyway, so thank you, Rodney, for Rodney's rates, and then we're going to move on to the news of the day. I love that screen. That's my favorite. This is where you have to sit on your shirt tail and that kind of stuff.
Yeah.
So the topics that Rodney and I have today. First one, and I'm going to lean on Rodney quite a bit. I've been doing that recently because he's the smart one of the crew here. But it's the article is some big changes to mortgage costs were just announced. There was some big changes according to Mortgage News Daily. Fannie and Freddie changed some LLPAs. Is that right, Rodney?
Yes, sir. And that's loan level pricing adjustments.
Okay, and then I'm gonna show you briefly so everybody can see this. And I'll show this to Rodney and everybody. This is what new versus old mean. This is the new deal, and the colors relate to the way it was. That's why it may be a little bit confusing. It's only showing one set of numbers, and that's the new numbers compared relative to the colors to the old numbers. And I'll take this away. But so if I've got, so we understand this, where we're going with this, Rodney. And some of these are going to be questions maybe we know the answers to already, but if somebody pops in later watching a rewind, a replay, they may not know. So when it says, what is meant by fees and costs? What does that mean when we're talking about loans? I guess there's a difference.
Yeah, let me go up here. Fees, I may have my own definition of these. The fees and costs, they're referring to the loan level pricing adjustments that Fannie and Freddie, our two agencies, that guarantee the vast majority of our rates, right, or our mortgages.
Right.
Your loan level pricing adjustments, or LLPAs, are based on your loan features, like credit score. If you want to throw that slide back up there, I'll give you a couple. I'll kind of go through what we're talking about. Let's say you can see the loan level of price adjustments are on the screen there. So if let's just say your credit score falls above 780, then that puts you on that top line, right? And
Right.
anywhere, so if it goes lower, that's where your credit score falls, and that's what loan level of price adjustments would be attached to that information I was showing you about the 5.5 earlier about the rate, right?
Yes.
So these fees would be basically attached to the fees, not necessarily the rate, but as you can see, some of these fees are so high that it would actually move the rate higher, if that makes sense. But let's just say if you're at 780, that very top line, to make it easy, and you were putting down, you were in that category where you're putting 20% down, 75 to 80% loan to value. You just go down in that one thing and you see that 0.125 right there.
Yeah.
It's basically charging you 0.125 just for that scenario, right? If you were putting 30% or 40% down, you see that goes to zero.
Oh, yeah. Okay. Yeah.
So, and then if you go above 80, look at this one, right? If you go above 80, they're giving you 1/8 of a point.
Huh.
So in 70 to 75 is a quarter, in 60 to 70 is a quarter. Now, 95, you go all the way to 95%, and you get charged 0.625 there, same as 97.
Right.
Now, does it strike you as a little bit odd that somebody at 70% loan to value has a 3/8 of a discount point charge because they're putting 10% more down? That's kind of strange, isn't it?
I guess it is.
I mean, you would think the 70, because normally this chart to me is based on risk, right? They charge.
Yeah, that's the way I would see it.
It's just weird like that. I don't know if it's because a lot of loans fall in that category and they just say, that's where, we're going to get it. But oftentimes this is what I'm looking at, because I'm like, how can somebody get, a charge or whatever, like that 0.25% is a charge, where this one at 80 to 85 is a negative, right?
Right.
Now you go down, now just go down this one right here, go down and look at the red. Like, why are they all of a sudden loving this 720 to 740 score?
I read a secondary article, and what they said was, after interpreting this, that they're suggesting that the middle, their words, not mine, the middle class is taking a beating with this new setup.
Well,
I
don't know, because like at 80%, you're getting, this is a discount, that red part, like
right.
You're getting 0.75. and if like you was putting, if you was putting 40%, or let's say you see that 60 to 70% LTV,
Right.
and then you go down to like the 720 score, so you're getting zero right there. But if you put down, a less money, only 15%, you go all the way to the right to that red 0.750 negative, and you're getting that's 0.75 of a point better in terms of how that can move your rate.
Huh.
Which that's probably a quarter to 3/8 of a rate right there. At least a quarter of a rate, a quarter percent in rate. So it's weird. This thing's coming out, I think May 5th, and it's kind of weird.
Yeah, that is right. It's coming up May, and they're suggesting that any of the loans that you see in May, this process will have begun in April or May. Is that right? Is that the way that works?
Let's see here. Yes, it actually says this applies to loans that are guaranteed to the agency starting May 1st.
Got it.
So yes, they're going to start it. We're going to start anything that's delivered in May has to have this on there. So we're going to have to start it for any loans. Obviously, we're going to delay it if it's worse. We're not going to use it. But if it's better, we may try to lock it there and see if we can do it that way and get and then deliver it May 1st or later.
Okay, so you can delay it that's a choice you have. So the next question I have is, what lenders / loans do these changes apply to?
Conventional.
Conventional loans?
Conventional loans.
Okay.
Any conventional loan, 15, 30-year ARMs, everything.
Got it. So it doesn't apply to FHA, VA, doesn't apply to jumbo or any non-conforming stuff. This is all middle of the road. Buy me a house, I'm Joe Normal American.
Just your normal vanilla conventional loan, which we do, 85% of the time. That's that loan. Now I think they could adjust it for like a 15-year. I think they might adjust it for like they'll give us some different ones for an ARMS, but right now that's the only thing I've seen.
Got it. That's interesting. And and is from your perspective as a lender, as a mortgage person, is this a big change? Is this significant? Or is this just standard fare what happens regularly?
I don't call it. I wouldn't think it's significant, and the reason I don't call it significant is because when Fannie and Freddie does it, it means everybody. It means every single person that around is going to do it, right? I mean, everybody's subject to the same rules, so it's not that great of a change, but to me it's kind of weird though. I'm anxious to see, because these things come out and then they come out and sometimes the feedback, Fannie or somebody will delay it or something, so I'm interested in it. If it goes through, I'm also interested in, what comes out about what are they trying to accomplish with this?
And that's the way I wanted to end this segment. Not that I am now, but that's the question. What's the motivation here? Because when I read through that article, what I was gleaning from the purpose of this is they're trying to make it easier for people that are, and I don't know how to use this term, maybe a little less qualified. I don't know. Is that the right way to say it?
Well, in the past, not necessarily qualifying. I think the only thing that they could, I think the biggest claim I think they could make is that if you look down further on the chart, the lower credit scores are significantly changed for the better.
Yes.
Like if you have a 640 score, I don't know what the old ones were. Does it show what the old ones were?
Now they do, and I went into it, and it was this 10-mile long scrolling set of numbers that I completely went to
Yeah,
sleep.
this is one of the easier charts to read right here for sure. But if you go down to the lower scores, you see it. Let's say if you're even under 639 and you're putting 20% down,
Yeah,
that's basically they're only hitting you 0.25 for your credit score right there, and that is nothing. I mean, that's not going to change anything. Um, that's like we have seen 16 basis points change in today's rates, right? So that
right,
20, that 25 is the same as the 16 that it got better. So, or
right.
you know what I'm saying. So
Yeah,
it's not that significant. But I'm thinking if I look at the old one, that could be a point or a point and a half better than what it was. Meaning
yeah,
conventional to me, the big part of this conventional could become, a lot easier for a lower credit score. However, I'm waiting to see just because the loan level pricing adjustments are there. Like, okay, I can now get you a price when you have a lower score, which is great.
right.
What I'm anxious to see is the approval going to go through Fannie's and Freddie's approval system. Like right now, I don't. They're they're tough on a. They're rightfully tough on a low credit score.
Well, yeah, because I mean that's just an assessment of risk. It isn't judging it personally. It's just
Right. It's just set up in a system like that. So even though the pricing is really great on the bottom end for this, a low credit score person, I mean, it's going to be awesome. But is the approval going to am I going to be able to get approval with it?
right. Yeah,
Because
and
I
you're not
haven't
gonna
seen where that's changed.
right, and you won't know that until you actually start running them.
Right, right.
I mean, yeah. We'll cover just a couple of things on this. That's really good stuff, Ronnie. Um, just a couple of points that I pulled out and for a comparison, it says um, what has changed in a nutshell, and it's the penalty for under 680 is less than what it was. The 659, for example, pays 1.5% on a 75% loan, which if somebody's got a 659 and they're coming up with 25%, that's an interesting mix, that
Well, I mean, it could be anything. I mean, you could have somebody could be perfect and have a credit card. You've seen it a million times where
yeah,
it's a perfect bar, and then it's like 2 months ago they didn't even know they had a late payment or missed a $25 payment on a credit card. I
yeah,
mean, it just kills them.
you never know.
It's
That's right.
like,
Nope. Yeah, yeah. And it's worth staying on top of that, but you're absolutely right. Absolutely an honest mistake. And I think that's probably the case most of the time. But before the changes, you'd pay 275. And so the difference, and I'm speaking in abstract really here. So the example on a $300,000 loan is the difference is $3,750 in closing costs from then to now. And that's one of the specific examples that they give. That's that
now
doesn't mean much.
instead of like they translate it into money, which I get, but really what would happen there, instead of like saying, okay, your closing costs are going to go down, what would happen is that we just that 3,700 would be used to go down several rates, to get the market rate for them. Like if they compare it to that old rate, they would get the old rate plus the 3,700. But when we go price it out, when any lender goes and price it out, they're just going to give them today's rate. Uh, it's not like they would actually be getting that money back, but they would get a lot lower rate.
Got it. Okay, that makes total sense. And besides, they said if there was a difference, that in some cases the lenders can help with the yield spread. If that's necessary, right?
Yeah. So
So
that's pretty much on any deal as well. So
got it right, and it's not it's not a requirement, but it's available sometimes if needed. I think is what I'm trying to say.
Yeah, a lot of times lenders use that yield spread to try to make things work, or if there's a repair, and the seller has to pay something. Sometimes we pay closing costs to try to offset that. A lot of lenders use that as, just a wage, just like realtors do. If sometimes they have to change commissions or whatever to get
Oh
something
yeah.
done,
Oh
we're
yeah.
all the same.
Yeah, yeah, yeah. We're just trying to make it work. So the next topic we had, and this is kind of a quick one, is that home sales slumped to a 12-year low. So the question is, why is that important? But that you have spoken several weeks in a row, which I think is wise about, and you just mentioned it only a moment ago about the floor, the floor bouncing off the floor, that kind of a thing with home prices, I think is what it was getting at. I'm distracted. I've got a technical thing here. 2 seconds. 2 seconds. There we go. Okay, we're back. And so home sales plunged to a 12-year low it ended up last year. It ended up at 4.02, which is the lowest it's been in forever. Just forever. I'm just going to shut that off.
Yeah.
But what has happened is that the lower mortgage rates raised the optimism for home buyers, and that the housing market floor could be near, meaning people talk about the crash, and when we go back to recessions and prices dropping and all that kind of stuff, the first place they go is it's the crash of 2007 all over again.
Mm-hmm.
And all we can do is provide some sort of indication that bottom's not there anymore. It's not the same. So it was going through this and said home median prices or home prices rose at the slowest pace since early in the pandemic. Well, what that's talking about, and you feel free to chime in here, man, is that we were on a rocket ship here this last year or so. Now, not the last 6 months, that's changed, but things have started to slow down, and this is further evidence that things are smoothing out. Would you agree with that?
Yeah, I think these are right on target with kind of where I think our market is and things like that. I mean, it's I can't figure it out. I can't figure out why um, I'm still having a few clients with that are getting rejected with multiple offers. It's like I don't get it. Inventory's up, but it seems like just the really good houses are the ones that are just. I mean, I know you've said it a million times. The really good ones are just like there's still multiple offers. I mean, I had one say they said they had 14 offers. I was like, don't even tell me about 14 offers. I don't want to hear about 14 offers.
In
But
Williamson?
yeah,
Yeah. I'm telling you that if a house is move-in ready and it's up to date, everybody wants it because that's human nature. And there's a lot of sellers, with all due respect, that are trying to sell and maybe it needs updating, but they don't feel like they need to do that. And
yeah,
so everybody even with inventory rising, there's a reason that there's houses out there with 30, 40, 60. I don't know if there's a ton with more than that, but with extended days on market, there's a reason for that. And the message is something needs to be fixed. Either update the property to get the price to rise, or lower the price to compensate for the lack of whatever's missing on the
yeah.
house. It's
Yeah, I mean that's on target because I can't. There's no other way to explain that. Every now you might can tell me too is a lot of our inventory new construction builds that are not finished that they're saying that we got. I thought we was around 4 to 5 months of inventory in basically our metro areas.
Well, the inventory here that I'm seeing is about 3 months, but
Okay.
but I didn't break that out by new builds. I don't pay as much attention to that as perhaps I should. I can tell you that builder confidence is up, which means there's going to be more permits. But then right behind that, you've got to have people. You got to have sales,
Yeah.
to keep them. I mean, these guys are investing a ton. They're taking I'm a fan of builders. They're taking a
Oh
huge
yeah.
risk to create those houses. And,
Yeah, the only
and
thing I'll say about the if builders' confidence is always the first to come back, we need the bank confidence to come back because a lot of them are, you know, a lot of them may be holding a lot of specs, that haven't sold. So,
yeah,
um, you know, we need a little bit of the bank confidence to come back. Just some of these to start selling. It'll be on.
that'd be a good thing. Well, and and,
Yeah.
and what that's what you're, and you can't go through during the course of the week. I read these articles, and I get stuff in my email inbox all the time. Hardly a day goes by where they're not um, pronouncing that new home builders are, giving all kinds of incentives. They're dropping
Yeah.
prices. They're doing what they got to do to move those spec homes. Because
Right. Yeah.
I would imagine construction loans are expensive. I don't know, but I would imagine that they are.
Yeah. It's
Um,
interest on. Yeah, it's interest. So.
oh God. So in terms of the slow sales, we've got it. Here's an interesting thing. Sales dropped, meaning it slowed down everywhere but in the West. So Northeast, South, everything slowed down. In the West, it must be a weather thing. It's mostly in California where it didn't. And I mean, figure that out. Um, Now they're also saying, yes, new home builders have shown improving confidence. Yes, but permits for future builds slowed to a 2.5-year low, and that's what I was just talking about. Is they can feel better about the market, but the proof of the pudding is in the eating, and that's where it comes. Permits is the evidence
Permit.
that you
Yeah.
feel good about things. I think
Yeah.
that's probably the case.
I
And we're
think that,
getting,
yeah, I think that if builder confidence come back, a little bit of sales come back, the banks will get a little bit more excited about, their inventory and things like that.
yeah, I mean, yeah,
I
and
mean,
of course, it's just at the end of January, so we're just on the cusp of where things start to ramp up. Like I always tell people, the buyers come out when the daisies do. And
mhm.
you watch in March when the flowers start coming out, the listings and the buyers will come out too. Um,
Yeah, I would. I'm hoping there's, a lot of new construction coming available, you know, spring and fall, spring and summer.
yeah, yeah. Well,
It'd
and
be
this is
nice.
going to be. I think that we've been kind of, I don't know, preaching is the wrong word, but we've been promoting the idea that it's a mess behind us. That's just if you look behind us, it's a train wreck. Just call it what it is. That's at least the way I see it. But what seems to be saying in the numbers is it looks like the worst of the housing market rout is behind us. When people talk about crashes, and we've gone through ad nauseum the evidence that nobody
Right.
knows.
Yeah.
And with the numbers that you're showing us on, with the lending numbers and the Rodney's rates, that seems to be stable. It's up and down a little, but
Right.
on the grand scale, we're all right. Um, and the lower, and another thing that's proven to be true that you've predicted is that rates don't have to go down a bunch for people to believe that it's okay to start buying again from 7 to 6, or I think it's, what is it, 6.2 today? I don't know.
Yeah.
But
Low, very
with
low
the,
sixes. Yeah.
yeah, the low sixes, that's all it takes for somebody to believe that it's going to be okay. We're headed in the right direction.
Right. And there'll be another group at 6, and then there'll be another group at 5. 5.75. It just continue to feel better and better about as rates drop a little bit. I
Yeah,
think people will come off the shelves like that, if that makes sense.
it does. It makes total sense. A couple of other points on this, and we'll just do one more article and call it a day because I've talked too much. But here's the economist for Realtor.com. His name is Lawrence Yun, and a lot of people look to him. Now, I'll be the first to confess that of all the surveys that you and I have done over the past weeks that have been published, Realtor.com and the National Association of Realtors, I love those entities, but they tend to be pretty positive because I think they're in the industry that being positive benefits all of us. It benefits
Right.
all of us versus some of these other companies are saying it's going to be a 20% crash. Why they
Right.
shorting something? I don't know what's going on with these
Yeah.
guys.
Yeah, I've noticed that sometimes they're at the top of the list when it comes to optimism, which is good. I mean, that's hey,
Yeah,
you know,
yeah. Well, I mean,
they're going to be a lot closer than that guy at the bottom. I can tell you that.
I can tell you, and all things being equal, if nobody knows, let's be positive about it, because
Right.
I mean, it turns into
Yeah.
we were talking about recession, all that kind of stuff, and how the engine of the economy is perception. And if you think things are bad, lo and behold, that's the way it goes, But if you think they're getting better, how about it? They get better.
Yeah.
So what he had said was, and this was, I thought, a pretty interesting comment, was half the country of sellers are likely to offer potential buyers discounts compared to last year. So what he's saying is half of the country is waking up to the fact that prices are, I'm going to call them normalizing.
Yeah.
I'm not saying dropping or anything. And then there is an Oxford economist. I couldn't even pronounce her name, so I didn't include it. But she's expecting an actual decline in prices year over year in 23. And now what that means is the year over year prices. So is it going to go down? But it was a tiny amount, like 1%, 1.5%. Well, that's manageable,
Right. That's
That's-
not. I mean, that's nothing really.
That it is nothing. I mean, if you could call it a safe zone, I think that's okay. So the last couple of points on this, and I'll take one if you want to take one. The inventory comparisons, when we were talking about what is it that people typically jump on, is what about everybody relates to the crash of 07, and I know we've talked that to death, but that's never going to die. That's in some people's DNA, as that's our history, and everything that looks bad looks like that. And that's
Yeah.
just not the case,
No.
And here's a couple of things to look at. You were asking about inventory a minute ago, Rodney. And it says the current inventory would take, and this is where I got my number from, was 2.9 months to clear the table. And if you know how that works, you take the number of buyers, the number of inventory, you stop the buyer input of numbers. How long would it take them to buy out and clear the table so that there's no houses left? That's called an absorption rate. So it would take 3 months. Well, last year it was 1.7 months. And that's why prices were going through the roof. Versus in 07, it was 9.6 months of inventory.
Yeah.
Now, if that's happening, people are dropping prices just to get their home noticed.
Right. Well, the 07 thing is probably half the country had bought within 24 months, or I don't know what that number is, but half the foreclosures were probably resulting in bad, bad loan products that was pushed, right?
Right.
No income, crazy nonsense like that. And then you couple that with the fact that they did not go through what we have just gone through, like basically 10 or 12 years of solid appreciation, with the last two being record rocket ship appreciation. So there's going to be no foreclosure. Like you could lose your job, lose everything, and just turn around, sell your house, and make some money and leave. You know what I'm saying? So that is just those two factors would take 07 out of the market. But there's also that saying that our recessions and our recessions never last as long, or our depressions, whatever you call them. Like you go back to World War I, guess the Great Depression, and then you go back in times, they never last as long and never get as bad as they were in the past. Like, when we talk about, we've seen 17% rates, we're probably never going to see that again. I doubt our generation will ever see anything over 7 or 8%, like we got to, and the market started taking those, for long-term investments at 7%. So we're not going to, there's always that theory is that you never get as bad as you were in the depression or recession or whatever before. And so, yeah, just with this economy, it's totally different, like we've talked about, but there's no chance of that.
Yeah, I can say that with some confidence too. And I think
Yeah.
probably people, we just learn from our mistakes faster, maybe, maybe
Oh,
that's
yeah.
it. So maybe we can cover this number 3, that Americans Wildly part, and we can save the main topic for next week because I'd like to do a little more research. The main topic I had planned for was the cross market demand is still high. And what was interesting is that, and it kind of dovetails into what we've been talking about, is that people move, they follow the money. If there's good deals in Michigan, well, that's where they're going to go. And that's what that article is about, but I want to be able to cover it better. So instead, we'll just kind of move that to the slate next week. But the third one I thought was pretty interesting, and I hope everybody's okay with this one. It's called Americans Wildly Misinformed on the Housing Market. And I think that that's a fair comment because there's a bunch of crazy information out there, really, So if you want to, I'll take like the first one, and if you want to take the second one, that's
All right.
So a new survey by personal finance company NerdWallet, pretty good company, found that 28 million Americans plan to purchase a home in 2023. That's a pretty good number.
That's a phenomenal number, isn't it? Wow. That's
I said
awesome.
23. I think it's 28 million. That's pretty good.
Yeah.
And so,
All right. On average, they expect to spend 269.2, which is over 100,000 less than the median price in the December 2021.
yeah.
So,
And so
that seems like that might be a problem.
Because what
they expect it to. So this is what I was thinking about when you talked about Mr. U up there. He was talking about, you were saying 50% of the people or 50% of the company, whatever is going to, or country is going to offer discounts.
right.
And I'm like, I understand where he's going with it, but I understand that the realtors I talk to still think that convincing a seller is difficult right now. So he's got a little coming around to do on that one, but it's kind of like this, you know what I'm saying? It's like, he hadn't talked to a seller in a minute, has he? But
yeah.
they're not going to. There's not enough inventory for that.
Yeah. No. Mm-mm. No.
I'll let you. Yeah, we'll just say there's not enough inventory. We'll see how that works out, though.
Yeah, we'll just see how that. We'll see how he comes through on that one. So 2/3 of Americans surveyed expect a crash in the housing market. That is a point that I am not a bit surprised by. Meaning,
Man, I actually am. I mean,
the 2/3 of Americans survey, which is, we got to remember what a survey is. Somebody's taken the survey that maybe doesn't pay attention to the housing market at
Right.
all. They read news about it. No thanks, But they're left with,
why are they thinking there's a crash in the housing market?
well, go on YouTube, man. It's like, if you type in housing market, the first 6 of them are going to be housing crash. I mean, it's just, that's what gets attention. That's what gets clicks.
Yeah.
So anyway, that was number 3.
That's wild. All right, real estate comments do not predict a crash. Lawrence Young, there's my man. Chief economist for the National Association of Realtors forecast an average sale price of $385 for this year, similar to last year.
Okay. All right. Okay. So
I'm
he's
with
saying, yeah, see, and he's a pretty smart guy, but he's guessing too. So number 5 is going to be Redfin predicts a 4% drop in home prices in 2023, which is not considered a crash. Anything inside or less than 10% is considered a correction. So that's what Redfin predicts. And we've said that before, and we'll see. You show me June, and I'll tell you, we've got a direction we could probably sink our teeth into. Ready?
All right. 61% of Americans believe current mortgage rates are unprecedented. which is which is not accurate, as rates have been in the 6 to 7 range as recently as 2008. Wow. What? I'm
That's
old.
an amazing statement.
It really is. It really is. I mean, because it's it's like all of our parents are. I'm 54, so I'm always used to hearing somebody just a little bit older than me talking about 16, 17%. I mean, that's the first thing they always throw at me, knowing I'm in mortgage. I did this 16% FHA and bought down 2 points.
And we were fine.
Yeah, yes, and we
And
loved
we're
it.
still here.
Yeah, I haven't refinanced just to show them.
We took 16%. But I tell you what that statement makes me feel. I'm thrilled that we're putting information out there to say to folks, it's not unprecedented.
Yeah.
We're okay. That's what I'm.
Yeah.
New
And predicting a
information.
crash.
We're okay.
Yeah.
And the thing is, that's a pretty large sampling, if I'm not mistaken. So, for anybody that's watching this and has gotten this far, God bless you for that. Give us a like and hit the subscribe button. But we're trying to work this through with you. So the next one is that one knocked me off my pins there. The average rate for a 30-year fixed mortgage hit 6.15 last week. That's accurate, according to the Federal Reserve. So nothing more to be adding to that.
Yeah. Historically, mortgage rates have averaged 7.75 over the past 50 years. Wow.
There you go. So we're right in the pocket. We're better than that.
Yes. Yes. But that's one of these stickers I want to throw away and tear off and throw away. We need to get that number down.
Yeah.
Today's buyers aren't. The problem when you average 16% in there, our today's buyers hadn't even heard of that.
Absolutely. We've got to help people remember that those low rates, as wonderful as they were, remember, the Fed was trying to generate energy for an economy that was stalling out after COVID came along and just crushed it. And so they went down to zero, and they were trying to get the dollar moving again, so we have to, and that's how those rates, I believe, got to as low as they did. Pretty sure
They were artificially lower, yes.
Yes. And so number 9 is going to be the Federal Reserve cut rates there you go. In 2008 to stimulate the economy, but due to inflation, rates have returned. Okay. So I didn't even know that was next. Ready. Number 10.
Survey found that 70% of Americans who had planned to buy a home in 22 did not succeed. Wow. Either because their offers were not accepted or they could not find affordable homes. 70%. I have not seen that number.
70%. That's a big chunk of people. And that translates in my book to pent up demand.
Yes. That should be, what was that 23 million number we seen earlier?
28
million. Yeah. That's wow.
That's pent up demand.
That's 7 out of 10 could not buy. That's a lot. Right.
And you gave an example of the perfect example, that somebody they got beat out on multiple offers. And isn't it interesting that person, and I respect this completely, they couldn't get the house that had multiple offers and chose not to make an offer on one of the houses that's been on the market for a period of time with no other offers. Isn't that an interesting? Because they've got options.
Yeah, you're talking about now. You want to find the proof in the pudding on Fix Your House. That's it.
That's it. Everybody's crowding into the nice places because if you're going to pay high prices, you want to get as nice a car as you can, right?
Yeah.
Little hidden message there. Oh God, how fun! Well, I'd say maybe have we worked it over pretty good? Are we good for today? Do you think?
Yeah, I'm good. Let's see here. See if there's anything else I wanted to. Some of these numbers, man. You know what? I think like this last section here.
Yes.
I would hate. I don't think these are good theories for Americans to be basing personal financial decisions on. Like if they think like this right here, their house, I think they should be a little bit more understanding on their house, right? When you go through rocket ship appreciation like we have, I mean, you just
Yes.
can't expect that all the time. And then when it stops, yeah, it's going to tick backwards for just a half a second or
Which
something, you
section are
know?
you talking about? Misinformation section?
Yes, the misinformation, just kind of all of it in general is like the
Got
2/3 American expected a crash. They thought that this was we've never seen these rates in the history before.
right,
I'm just
right.
thinking that these are not good. Not the way to be thinking if you're making financial decisions on buying or selling a house.
Yeah, yeah, yeah.
You know,
And all we
but
can do as two guys in in Williamson County, Tennessee, is keep promoting the idea that we're okay. And I
yeah,
think it's as far as I'd go with that, but that's always been your message. And even though when things get a little scary, concerning, better word, we're still okay. But
yeah,
this shows you that it shows you that way out there, like a house for now. Now, to be honest, you can go to some of these places when we're looking on the migration section. There's some places like in Michigan where were some of those I can't. It's too much to read through too quickly. You can get homes for $289,000 in some Detroit. You can do that.
right.
You know, you can do that. But in general, the median price isn't going to
Right.
support that. So
Yeah, and that's what I was talking about. I was like looking if everybody's looking at that median price, if um the one that says 28 million's planned to buy,
yes,
but they all plan to buy $100,000 low below the median price. That's
that's a
that's
problem.
obviously a problem. Yeah. So
And could you imagine 28 million? Well, how many homes did we sell this last year? 4.02 million.
it was more than 4 million last year, right?
No, 4.02 was the adjusted seasonal gross on
Wow.
it. 4.02. They had, which is better than, surprisingly, which is better than they had predicted. Some had projected 3.96 million. But when they closed out the books for whatever that's worth in December, it ended up at 4.02. And if you remember, for the last, even before COVID, it was 5.6, 5.7, pushing 6. That was
Yeah.
anywhere between 5, 4, and 6 is where it tended to float around. So when you're talking about a total number of closed properties at 4.02, that's nothing. And it's no wonder there's few listings coming online, not very many, there's not. But inventory tends to grow because nobody's buying,
Yeah.
you know. It's a weird thing, you know. And that's what this year is. I'm so excited about that. That was a good article to bring up. I'm so excited about what this year has to bring because I believe what we all are looking for, you and me, Mr. Seller, Mr. Buyer, anybody, is some sort of clarity. Certainty is probably a better word. Now, I don't know that we're going to get perfect clarity, you know,
Yeah.
but if we saw 4 or 5 or 6 months where the rates stayed within that sine curve that you have so kindly shown us every week, we're in good shape, you know. And if prices are staying flat, stable ish, we're in great shape, you know.
Yeah. Job, if they're, if somebody feels good about their job, I mean, yeah, I mean, it's we've done it a bunch of times and do it again. You know, the rent versus own and things like that. It's home ownership is still can't be
Yeah.
beaten.
And and the bottom line for all this stuff, Rodney, is I'll go out on a limb. And we don't know. I think that what they're predicting is it went from the Fed rate of pushing for 0.5 to 0.25. I don't know where that's actually going to land, but things are looking pretty good. The producer price index was better than they expected. But it looks like we've kind of made it through the tough time, meaning the end of last year just scared everybody to death. And it looks to me like a soft landing actually might happen. Of course, what do I know? I'm an idiot, but that's what
Well,
it
I don't
looks
know
like.
anything either, but I can tell you, just from our local area that we're seeing, increase in activity and
Yeah.
just like normal, just like this time of year it starts. People start, you know, putting offers in and getting pre-approved and things like that. So
Yeah, it's going to be good. It's great. Well, that's cool. Well, once again, my name is, I think I kind of forgot this part. My name is Andy Elliott. I work with Benchmark Realty down here in Williamson County. That's Franklin, Tennessee, but we're in Williamson County. I live in Brentwood, and Rodney Wilds is he's the VP of F&M Mortgage, also in Brentwood, Tennessee. If you have questions for us that would last beyond just a phone call or an email or a text, just give us a call. All of our contact information is in the description box. We'd love to talk to you. We're not trying to sell anything. I don't care where you're calling from the country. You can call from anywhere, and we'll do our best to help you or find somebody that can help you in your area if that's the case. So, Rodney, I can't thank you enough for a number of things, but especially today. You have anything, last parting shots?
no, I'm good. Good. I like our information day. I'd, it's pretty wild. Some of these surveys, kind of eye opening for me. I'm like, wow, I can't believe that people. I guess I'm in it. That crash thing is just kind of set on me. It's like people are expecting a crash. I'm like, why? Our inventory is still under where it needs to be, and you
Yeah,
know.
yeah.
So
It's
anyway,
surprising. It tells you what
it's
we're up
wild. Yeah,
against. It tells you what we're up against sometimes in the
yeah.
flow of information. Anyway,
News.
that's good. Hey, thanks for everything. See you everybody Tuesday next week. Rodney, we'll see you next week Tuesday, right?
You got it.
Okay,
See
man. Here we
y'all.
go. See you now.